Welcome back to another episode of me sticking my nose into these charts every single day until I discover a trade model that makes me millions and millions of dollars. And today, I was actually able to call the market in real time and predict exactly what it was going to do before it did it. Now, I know that sounds absolutely insane. And I used to think that was insane too. But now I know that it is possible, which is just a huge paradigm shift. Huge paradigm shift from how I used to trade. It's hard to fathom. So, first of all, before I get into this, explain the logic behind it, let me show y'all how I used to trade. So this is how I used to trade. I used to absolutely torture myself trading order flow with supply and demand. Everything felt like a guessing game. I had constant anxiety. I was always in fear. Literally, when that 9:30 bell rang, I would feel nothing but fear and anxiety because I had no idea what I was doing. I had no idea what I was looking for. Everything felt random. I was scared. When you operate like this, you are scared because you don't know what it's going to do. But if you operate like this, you have confidence because you know what it's going to do before it does it, which is just, it's hard to believe. It's really hard to believe. But if you take the time to study the 2024 ICT mentorship, all of this will make sense. And you will understand that, yes, it is possible to predict where the market's going to go before it does it. But you have to understand those principles first. You have to do the due diligence of going through and studying it. But anyways, back to this. I used to torture myself trading this way. I would look at heat maps. I would look at delta footprints. Everything felt random. I never really had a trade model. I felt confused. I was lost. Everything that I did was so impulsive. I was just constantly chasing the market because I was just sitting there watching every up and down tick of the market. And it would go boop, 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 uptick. Oh, I'm long. Boop, down tick. Oh, I'm short. Oh, I see green bubbles coming in. Let me get long. And then I realized that all of this is completely unnecessary. And all you need is literally the candlesticks. The candlesticks tell you absolutely everything. That's all you need. And that's the beauty in it because it's so simple. And once you understand the language that these candlesticks communicate, then you just follow it. And it's beautiful. And you know what it's going to do before it does it. Crazy. Absolutely crazy. So let me explain the logic behind this and how I was able to predict what the market was going to do in real time before it happened. So let me read my journal entry from today, the 13th of September, 2024. Hold on, let me pull this up. Nope, not that. Intraday observations, 9/24, 9/13/24. Okay. So, this is what I was thinking. So I wrote down a timestamp next to my entry, or next to the little paragraph that I wrote down, because I knew that this was absolutely going to happen. So at 10:18 this morning, New York time, I wrote down, I would get short on this future inverse fair value gap. So I was calling it as an inverse fair value gap before it was an inverse fair value gap, and you can see it here in the chart. I said I would get short on this future inverse fair value gap. It's going to run that high, break down, give me a sell scenario with the breaker, limit order goes on the inverse fair value gap, take it down into first presentation. That would be a good draw on liquidity. If not, it'll keep pressing higher to new day opening gaps above. In that case, goodbye, meaning I'm not interested in it. So I said that at 10:18. If we go to 10:18's 1 minute candle, it's this. So at this candle right here, I said that we are going to run that high. Then we are going to break down, trade through this bullish fair value gap, use it as an inverse fair value gap, and then roll over into first presentation. Now, it didn't occur literally exactly as I planned out because initially I thought we were going to break down when we took this high. But since we ran that high and we traded down into the bullish fair value gap, still supporting it. There was no change in the state of delivery. The market is still in a buy program, seeking buy stops. It just simply ran this high and then did exactly what I was anticipating it to do. So we ran this high, large downrange candle, close through the bullish fair value gap, and then at this point I want to see it trade back up into it, act as rocket fuel, and send that thing lower right down into first presentation. And first presentation is simply the first fair value gap that I see after the 9:30 open, and that literally happens exactly as I planned. Crazy. Absolutely crazy. So here's what I was seeing at this time that made me anticipate this. Now, if you notice here, we have relative equal highs. So retail sees that as what? As resistance. Now, what do? When the market turns away from this level, they're going to chase it short. They're going to sell short. They're going to place their buy stop order above the relative equal highs because that's what the books tell you to do. It's classic support and resistance. It's just normal thinking. And normal thinking in this market does not work. It absolutely does not work. So if you notice, each time price comes up and takes the previous short-term high, there is a lack of displacement. We're seeing a lack of a move to the upside or the downside. It's not necessarily going anywhere. So when I see this kind of price action, every time the market forms a short-term high and takes it out, there is somebody on the other side of that trade accumulating those buy stops. They are accumulating buy-side liquidity. So there is somebody on the other side of that trade selling to those buy market orders that are tripped into the marketplace when it breaks these short-term highs. So each time it does this, what is it doing? Accumulating shorts, accumulating shorts, accumulating shorts, and then finally, boom, breaks down, inverses this, uses it as resistance, propels into first presentation. So I'm seeing this and I'm thinking accumulation of sorts. Somebody is on the other side of that trade taking those orders. Now, if you also look below the marketplace, we have another classic retail idea that I want to fade. What do you see? I have it drawn out here. It's a trend line. So each time the market comes down and tests this trend line, what is retail going to do? They're going to get long off of that, especially when, if I just go up to the daily chart real quick, especially if the past 2 days have been doing this, just going up, right? Retail sees a trend line intraday and they're getting long off of that. So what is this doing? This is engineering sell side liquidity to where these shorts can offload their short positions to willing buyers at a lower price. Underneath this trend line, the market is engineering sell-side liquidity because retail traders go long off of this. If they're going long, in order to protect that long position when they are wrong and when they stop out of the trade, they place a sell stop limit order. What does that do? When that gets triggered, that sends a sell market order into the marketplace. So if you're selling up short here, you are able to buy back from sellers at a lower price. So this is engineering sell-side liquidity. For when those traders get stopped out, you have willing sellers at a lower price. And smart money is the counterparty to that trade. They're offloading their short positions to willing sellers at a lower price. So I had to pause and think about it real quick. Kind of trips me up every now and then. But exactly as I outlined, it happens. Exactly as I outlined. So number one, we have accumulation of short positions above relative equal highs, and each time we take out a short-term high, but we see a lack of displacement. That is indicative of somebody taking the other side of that trade, accumulating short positions. So I don't have a valid trade idea until I see an opposing imbalance inversed. That is my trade model. I have to see an opposing imbalance inversed. And you can see that holds true here because we trade down into it here, but we support it. It's still acting as support. Then we trade higher and break this short-term high. So at this point, I don't have a trade idea. As soon as I see it slice through this, then I have a trade idea. And look how this candle opens, trades up into it, closes lower, and then look at the following two candles. We accelerate down into first presentation, also taking out the rest of the sell-side liquidity below this low. Now, if I go to the 5-minute, here is also what framed the logic behind this trade. Now, if I look at the 5-minute, I also see a potential breaker formation on the 5-minute because we have this down close candle right here. And if I see a large range down close candle that closes below these two candles, these up close candles, that would validate that as a bearish order block. That would validate a change in the state of delivery, and that would validate this as a bearish breaker. So if I see a large down close candle here, it does all kinds of things to validate my trade idea here. It has a change in the state of delivery. We now have a bearish order block, and we now have a bearish breaker. So we have a high, a low, a higher high, and a lower low. And you can see that is true, right? And here's where that inversion fair value gap is on the 1-minute time frame. So when this candle was an indecisive candle right here and ran this high, I'll pull this up real quick. Nope, not that. Thank you. 5-minute. So I'm going to put these side by side and explain what I was thinking in the moment. So this is simply because I've seen this happen over and over and over again through the past couple of weeks, 4 weeks now that I've been watching price action, watching breakers form in real time. We have two up close candles, right? So if we close below this, like I said earlier, change in the state of delivery, bearish order block, bearish breaker. So while we're up here driving above this high on this candle right here, I wrote it down in my journal, I want an aggressive drop now, because we drove above this high, and I'm looking at these series of up close candles, and if we were to get an aggressive drop starting here, then that would validate all these premium arrays on the left side of the chart, because this would become a bearish order block, this would become a bearish breaker, and we have a change in the state of delivery. So that would validate everything on the higher time frame as well as the lower time frame. Give me exactly what I need to see. And I anticipated first presentation to be my draw on liquidity, and look where the market ends up reaching down into, the new day opening gap low, and it literally just stops and turns on a dime. So that could have been a potential partial right there as well. Now, if I'm being honest, I thought this would potentially be the high of day, and we maybe keep distributing lower, attack the sell side below here, because it is Friday. We've had a one side directional move all week with this large up close candle. So I'm thinking maybe we could see a 20 to 30% retracement on the weekly range, because it is Friday, and we could see a TGIF setup. So here marks 20% of the weekly range. Now you can clearly see that's not the case. But why is that not the case? Because look what we have above the marketplace. Look at all the new day opening gaps and new week opening gaps above price, and they're in close proximity. So what is that going to do? That's going to act like a black hole, and that is going to suck price right into it. Very strong draw on liquidity. And if we look back in time, if I pull up my 15-minute chart, this was just a supercharged draw on liquidity. Like it just got sucked into this thing over and over and over again. So we can see that we have what? These purple lines right here are a new day opening gap. Outside of that, we have a new week opening gap. So what do we have? We have a new day opening gap nested inside of a new... We have a new day opening gap nested inside of a new week opening gap. So that is a supercharged draw on liquidity. And notice how each time we leave it, we come back to it. We leave it, come back, leave it, come back, leave it, come back. Leave it, look how far away we trade from it, and then it just literally a black hole sucks it all the way back up into it. Leave it, come back, leave it, come back, right? Leave it, come back, leave it, come back, leave it, come back. And then finally, we run away from it. And now we're in close proximity to it again. So look how far we traveled away from this level, and we're still getting sucked back into it. Not only that, but we also have this huge pool of buy-side liquidity over here that's going to act like a huge magnet to price. So this could be the terminus for this price run. Price is clearly drawing towards this level right here. So coming into today, I had two scenarios in mind. Number one, we see a potential TGIF setup, a 20 to 30% retracement back into the weekly range from the highest high to the highest low, because it is Friday and we've had a one-side expansion move, or we simply just keep trading higher, gravitate up into these right here and this up here. But coming into today, I saw that the daily profile looked pretty similar to what we saw yesterday. Notice how we just have a bunch of back and forth action, and initially we drop down lower, we trade into this discount array right here, and then we distribute higher throughout the remainder of the session, which is essentially what we're seeing today. It's the same thing. A lot of back and forth, We have an initial drop lower, take out the sell stops, and now we're just distributing higher. So those are my two expectations for today. Now we can clearly see that the market is obviously reaching for this, but I was still able to get a little bit of a short position. Little tiny piece of the move, which doesn't bother me at all, because look at the conditions today. They're not the best, obviously. Pretty lackluster. Why are they lackluster? Because look at the opening range gap. So if we measure the opening range gap, it is only 10 handles. Anytime we have an opening range gap less than 20 handles, we immediately have low expectations for price action in that session. So we can expect muddy conditions. We can expect picket fence action, where it's just back and forth and back and forth and back and forth like this, right? So the whole time I had very low expectations for the morning session today, and I just wanted to sit out the first 30 minutes. We also had a news driver at 10 a.m., so I wanted to wait for that to come out. But I want to sit out the first 30 minutes and not do anything until it absolutely makes sense to me, which it made sense to me here because we were just building all this low resistance liquidity. We were accumulating short positions above these highs, and then boom, break down, inverse the buy side imbalance, trade up into it, use it as resistance, and rocket lower. So that was my small trade today. Now, obviously, I just caught a little tiny piece of the move. This was the real move. And I wasn't willing to long the market because it didn't really give me anything of quality. Now, I did see my breaker formation right here, right? We have a low, a high, a lower low, and a higher high, clearing out the primary sell side liquidity. But it never traded back down into that inversion fair value gap. Now, it did here and here. But, I mean, the conditions, they just weren't it. So this is just a day that I would either don't trade at all or maybe do something like this. Maybe not even. So I learned a lot today about how I can expect the market to behave when we have a very small opening range gap of less than 20 handles. Not only that, but it's also a Friday. So Fridays don't tend to be the highest quality trading days, and add a small opening range gap to that, and it doesn't make for a quality trading session. So I had very low expectations coming into today, although I was able to watch this play out in real time, which was mind-blowing. So that is going to be it for today, and this marks 4 weeks of watching price action live, my first month of watching price action live after studying ICT. A pretty solid week. I learned a lot. I really learned that less is more, and I finally discovered a trade model, outlined it, which I can show here. Finally discovered a trade model, and I outlined it in this simple little drawing right here, which basically occurred today, right? We have a high, low, higher high, a lower low, but there has to be some sort of logic behind that. Usually I want to see it engage a higher time frame premium array, but based on what I was seeing on the 1 minute, it was very clear to me that the market was accumulating short positions, and that is why I took this short, although we never engage a higher time frame premium array, right? But use that logic for the 1 minute and the 5 minute, and that was able to present me this, and that's about it. So tomorrow I'm going to do my weekly review, going to study exactly where I went wrong this week, because that's where the valuable lessons come from. You have to appreciate your losses. Your losses reveal the most insight about yourself and the market. You appreciate the value that they bring. Please do that, because it's healthy for your trading. It's good for you. You are only winning in the end by losing if you go back and extract those lessons. So now that is it for today. All right, goodbye.